This is our Forex blog for April 15th, 2011. And what we do most days, and today as well, is look at each currency and find out which ones have the strongest and weakest trends, the real-time trends in histogram format on the top, and the daily, weekly, monthly trends underneath that. You can see the dollar across the board is very weak, but other than about an hour earlier today, half an hour here, and then for the last 2 hours now, it's not been weak today. Currencies that are very weak and have gone down day after day after day, typically have a counter trend day. And if you are aware of how many days or a week or two, if a currency has gone straight up or straight down, and you see some real-time strength in a weak currency, then you can certainly trade it on the long side. But just be aware that that counter trend up move can end at any time. Between the two, the yen is the stronger of the two. Its weekly trend pretty much was barely up, daily trend up, and the monthly trend still down, obviously. I focus mostly on an intraday basis on the middle weekly trend. So between the two today, the yen is a far safer bet, not only because it has more strength, but because it doesn't have a weak weekly trend, and its daily trend also is stronger. So that being the case, a little bit later today, the euro shifted a weekly trend down and had a lot of weakness. The CAD was weak across the board. So selling the CAD yen up until about 8 when it was weak during that time was a very high probability trade. Here's the CAD yen. Notice when it broke underneath the hourly, a lot of times it comes up to the hourly then fails. When a currency breaks from underneath above it and comes back down and can't break the hourly here, typically you want to buy here. And when it goes back up, notice there's almost no statistical strength compared to the weakness before, so you would bail on that trade, maybe making 2 to 3 pips. And when it breaks down underneath the hourly, you get short again, and you can see the weakness comes back in. And most of the time, you can expect Fibonacci profit targets as your profit target. It shot through the first one, came to the second one almost to the pip, counter trend buy signal right here, and you're out of your trade. And then you're looking for a counter trend trade, or a pullback again. You might have shorted here at the 38% retracement, and your stop above the high, pulled back about 8 or 10 pips, you move your stop in half, comes up, stops you out, maybe you lost 5 pips. Then it retraces again. This is a perfect example of an Elliott two-way fib pullback. Notice it went right to the 1.618 level, and at 6 o'clock here, very high probability place to sell because we're underneath the previous week's low right here, and that's major resistance coming up to it from underneath. Using a tick chart around 6 would improve your odds even more. Here's 6 o'clock, and a pretty high percentage of CAD pairs are going up and yen pairs are going down, so you might not have shorted it right here, but when it went up and barely made a higher high and came back and the bars went red, you go short. And as it comes down and kind of goes sideways here, you move your stop above here, and you don't know how far it's going to go down, but most of the time when you're trading with the trend, if it's underneath the hourly, most of the time it's going to go to the first or second fib target. So we're short somewhere up here around 55, out at 33 for the first half, and it's kind of chopping around here at the 1.618. You'd be out at 28 on the second half. Very high probability trade, and it's a perfect example of an Elliott two-wave pullback in the direction of the trend. As I said earlier, the euro had consistent weakness throughout the day, and so you would be looking to sell the euro yen. And you can see it really fell off a cliff last night, but it was above the hourly and it found support here. Anytime you find a bounce off the hourly like that and it's not able to go up, when it breaks down, this is a very high probability place to go short. You can see it fell almost 50 pips here, and you might have gone short right here. Probably would have made 5 pips on that. And again, on this pullback, it came really close to the hourly right here at 320. Let's look at our tick chart with our FX scalper on it at 320 in the morning. It's going to really allow you to have the tiniest loss, if you're wrong about the entry. For example, here it comes up. If you're afraid to have sold it here, you can see a mini 1-2-3 pattern. A 1-2-3 pattern is when the market goes up, pulls back, the trend, the trend for the day is down. It's underneath the hourly, but on the tick chart it appears up. But it pulls back, comes back about 50 to 62% of this down move. Can't go higher, and then when it breaks down, you can get into this trade with a very low risk because your stop's a few pips above this high here, maybe 10 or 12 pip risk. And again, anytime you trade with a trend, usually the market makes at least 2 waves your direction. So you're short, right here around 57, and these are good places to get out with a profit target. You made about 40 pips here, and another 50 pips on the second half. So very, very high probability trade. And when you see the markets going down with almost 100% of the euro pairs falling and yen pairs getting stronger, that's when you see spikes like that. It really adds to your probability. Here you have another pullback. It's a very decent sized pullback off the low, 30 pip move. You go short with your stop right above the high here, and you never know if the market's going to go below the lows. So if it comes down to the lows and stalls here, you get out with half, and then you might want to move your stop above this little swing area here. And if it does go lower, you draw your fibs from here to here, and the fib target is a good place to get out. And you can see, you got stopped out here. Notice also the percentage of euro pairs going down, yen pairs getting stronger, very high. As it's going down right here, even less. So it gave you kind of a warning that it's probably less likely to bust through there. And then when it went up, if you didn't get stopped out here, when it came back down again and barely made a lower low and came up, you want to definitely get out of your trade down there. Tick charts, sometimes they get you in or out of trades, too soon. However, they also, because of their very nature, have the tiniest of losses, when you're wrong. And that's one of the biggest things that new traders, do wrong. Now, the Australian got very strong here at 9, and a little bit later than that, the dollar got weak. The dollar was consistently less strong than the yen all day. So you could have been looking around 10 for some Australian dollar buys. Here's 10 o'clock. You can see it doesn't really explode up here, but on a tick chart, if you were looking at this at 10, notice the market busted out from underneath to above the hourly, pulled back to the hourly, didn't break it. You might have got into this trade right here. And a lot of times, like I've said probably thousands of times in class, the Fibonacci profit target's a great place to get out. And it busted out above the previous day's highs, kind of chopping around here. You might have moved your stop up underneath this area and got out of half your trade here. And then when it came up to the fib target, you're out of the second half right here at 60. But you got 20 pips on the second half, maybe 8 pips on the first half. That nets out to about 14 pips. Let's see what other trades we have. Oh yeah, also the New Zealand, obviously strong all day. The yen and the dollar were off and on, but mostly strong. But at 10 o'clock, the New Zealand was actually a better buy than even the Australian because it was consistently strong all day. And notice, it's above the hourly, pulls back to the hourly moving average right here. That's usually a really high probability trade. And at 9 o'clock right here, you can see when it pulls slightly underneath it and comes back above, you can go long right here. And you might have also went long right here. The market kind of went up a little bit. You can see the strength at the double top was half of what it was the second time. You get out of that trade with 2 or 3 pip loss. You get in here, market's kind of chopping around, then it takes off. And again, most of the time the market will go to the fib target of the previous wave, which is pretty much right there, and it's a monthly pivot level. Great place to get out of your trade for about a 30-something pip move. Very high probability.